In this video, I want to discuss a trading strategy that I use every single day, that it's very important concepts to understand about a markets auction, no matter what instrument you trade. I'm going to go over the rules of this strategy. I'm going to go over how I trade it, and I'm going to go over some important concepts that are applicable to any other market or any other auction that everybody watching this, I recommend implements into their own trading. That way you start taking better setups and also avoid trades that have a lower probability of working out. Before we get into it, all I ask is you hit the thumbs up button on this video, and if you're new, subscribe to my channel. I would appreciate it. Now, to understand this strategy completely, we have to be able to identify what a balanced range looks like and why balanced ranges form in terms of an auction. So in a markets auction, when it is very balanced and we almost have a heartbeat type of pattern where the market moves up and the rallies are getting sold into, the market moves down, the dips are getting bought into, and we see a period of consolidation where the market is very stagnant between a range of prices. When the market is ranging, we have to understand what is causing the range to develop. And this is simple economics 101, that when the demand is equal to the supply, we have an equilibrium or a balance between prices or a balance between participants who are buying and selling in the auction. When a range gets developed, it's safe to say that buyers and sellers are in equilibrium and they are agreeing on price. When we have an agreement in the market, this is when you're going to see the stagnation of prices where we move sideways. Now, that's not to say that in this stagnation and this balanced range that there aren't tons of opportunities to trade around. We have to first identify what forms the balanced range and then conform how we trade depending on these market conditions. Every single time the market comes near the low, the lows get bought up. Every time the market comes near the high, sellers appear and sellers are willing to sell at higher prices. So we have the market establishing in this range, and buyers are not willing to take the market up out of the range, and sellers, every time we come down to the lower portion of the range, are not strong enough to take us under the range and continue the market down. When we have this lack of participation between buyers and sellers, and in the middle of it, they are very equal and balancing out and ranging, this is when you're going to have the balanced state. And our job is to recognize this and trade around it. Now, here's a recent example on the S&P 500 where after we made a very strong move up, the market ranged and consolidated. And this is typical after a large move because the market needs to digest that move. So after the strong rally up off of this data for 2 sessions to follow, the market was very flat and ranged out in a very tight, about 40-point range. Now, near the highs, there was a supply zone that formed here, and near the lows, there was a demand zone that formed here. So now the balanced range, once you combine it with other indications such as supply, demand, or support and resistance, now becomes even better to base the trades off of. Now, how do I trade these balanced ranges even if I didn't have other indicators of supply and demand? Now, the first thing and my rule of thumb is I never long a breakout or I never long a rally towards the upper portion of the balanced range, whether we have supply or resistance there. Now, another rule of thumb is I never short a breakdown still above the balanced range low. Ideally, when the market is balanced, going back to the previous example, I want to be shorting the highs and buying the lows. The issue with a lot of traders is they don't understand the components of a markets auction, and they go to buy a breakout in a balanced state just to be provided liquidity for them to be buying for somebody else to be selling. Also, a lot of traders will see the market coming down and they will short a breakdown into a level where buyers were once present in a balanced state, which is just a recipe for a reversal. To validate this concept even further, let's relate this to a real estate auction. Now, let's put ourselves in the position of a seller of the home. We own this house and we want to sell it and get the best bang for our buck. Just to make this simple, down here, let's say the price of the house is $28,000, and up here, the price of the house is $80,000. And in the middle, let's call it $50,000. Well, if we're looking to sell the house, and we see that there's about 10 people interested in buying it at $50,000, maybe 50 people interested in buying it at $28,000, but maybe only one person willing to buy it at $80,000. who are we going to sell the house to? We're going to sell the house to the one guy that's willing to pay $80,000 for that house. This one guy who is willing to pay $80,000 shows that in terms of an auction, buyers are not willing to pay at higher prices. Buyers are not willing for us to take us out of this range and go auction much higher. And when this occurs, there's only one option and one way for the market to go, and that's down, because the market is a tool that just advertises price, that the market has to go down to see if buyers are willing to pay at lower prices. Now flip this a little bit. Now you go to the auction as a buyer and you're looking to purchase that house. Maybe nobody else shows up to the auction and you're the only guy that goes to bid $28,000 for that house. Now there's one guy down here. Aren't you going to get a good deal if you're buying at the lowest price, or the lowest price that anybody is willing to bid for that good? And we can relate this to the stock market in the sense of we are looking to establish these ranges and looking to buy at the lows and sell at the highs, not the opposite way around. Now, this was an actual trade that I took recently on the S&P 500, where the market had dipped down into a balanced range low, and it offers the best risk to reward opportunities there. For example, this trade, I risked $2,000 to make about an $8,000 profit, and it lasted a little under an hour. Essentially, I'm looking to buy the lows and take profits in the middle of the range or at the balanced range high, depending on the market conditions. In this example, the market had dipped down, and in balanced states, again, shorting a breakdown, what a lot of people will do is they will just simply mark a low in price. That as soon as this low breaks, not putting an emphasis on the market conditions, especially now that you're aware of the balance, what they will do is they will simply just buy a low of day breakdown, and by them selling, they essentially are just providing liquidity for somebody else to be buying. Or if you're an early long, for you to stop out, you have to sell, and that is just liquidity for other traders to buy this move, such as me, capitalizing on an upside rally. And then we could see another example a little later on in the session, and the market goes up to this upper portion of the balance range where it then rejects and the market sells off from that level. Now, just by looking at this chart impromptu, we can spot 1,000 other balanced range. I'm on a 30-minute chart, but I could even go down to a 4-hour chart and see the same exact thing right here, right? We could see a balanced range in this area right here. Market rallies up, balances, followed by another rally up thereafter. On a 2-hour chart, zooming in over here, we could see a balanced range over here. And I can do this all day long on smaller time frame and higher time frame, and the rules are applicable no matter what time frame that I use. Now here I could draw a balanced range low, and here also I could establish a balanced range high. My rule of thumb in these balanced states is I do not like trading in what I call no man's land. What no man's land is when the market is in that equilibrium where we're not at the highs and we're not at the lows. If the market is in the middle of the range, for me, it's always a lower quality condition in the middle of the range if it's not at the extremes or the edges of the highs or the lows. Because what might look like a really good setup will be in the middle of the range, and the market could either A, keep going down, or B, reverse in the middle of the range and then rally up. So I find it to be very low quality if you trade in the middle of the range or the white space or the noise. In this example, you could see tons of opportunities in this range, right? The market had moved up, it had sold off, but that was at the upper and lower portions of it, not really so much in the middle, and the probability scale completely diminishes in this range. And again, in this range, you have buyers and sellers essentially fighting it out. It's a constant tug of war battle between these buyers and sellers where they're in equilibrium because one side cannot outweigh the other. If it moves up, the buyers fail. If it moves down, the sellers fail, right? So why do we have to figure it out for the market? Or why do we have to join the tug of war battle? Why can't we trade once one side is winning that battle? Because once one side shows initiation or shows responsiveness, this will give us clues to open up that trade. Now, the market cannot stay in this balanced state forever. There will be a breakout or a breakdown at some point. The market moves from states of balance to imbalance to balance to imbalance, right? So whether it takes 5 minutes of a balanced state or maybe it takes 2-3 months of a balanced state. It will eventually break out or break down, and this is going to give us good signs of that initiative or responsive activity from other participants. When I talk about initiative, ideally, if the market is breaking out above the upper portion of that range, you'd want to see the market then pull back. And at some point, this acts as support of the previous upper balanced range in sort of a breakout and then retests. And now it's acting as support for a continued rally up. And maybe the market has another state of a strong rally and then balance thereafter. This would be initiative activity, and it would show that continuation is likely in the market's auction. Now, if at some point the market breaks out above the balanced state, but then fails, it shows responsive activity from sellers, and it's likely for the market to continue heading in the reversal direction and go towards the lower portion of the balanced range. Usually why this occurs is the market will break out above a high or below the low. It will pick up liquidity, meaning it will stop out traders for other traders to use that liquidity to build their position. This is why sometimes you'll stop out of a trade and then it eventually works out after you stop out. And then it completely, in this example, dumps towards the opposing side of the market. In this example, we could see a 3-session period of essentially this balanced state right here. Eventually, the market breaks out of this balanced state. We're breaking out above the balanced range high. And the balanced range high then acts as a level of interest that I have to cautiously be watching. This was a trade that I took on the S&P 500, and this setup offered $2,000 worth of risk. And I came out of this trade with a little under $16,000 profit on 15 full-sized ES contracts. It was a 7.61 risk to reward ratio by the time I sold this full position. And this was based off of initiative action of the market breaking out of the balanced range. So here's our balanced range high, our balanced range low. The market breaks out of this. Again, when we combine supply demand and support resistance, it's even more powerful with this concept because it validates the claims of a market auction. So here in this example, the market is trying to break out of this range. And once it's broken out of, you want to gauge either A, is this responsive, or B, is this initiative? In this example, the market had broken out above and the previous balanced range high then acted as support. This is what you want to see on a healthy continuation type of market where it continues going in that direction, showing initiative activity from those participants to bring the market and auction much higher. When I see action like this, it enables me to hold runners because I know the market is now going to discover new prices. The market has moved from a period of balance to a period of imbalance. So now my job taking the market long at this level of the balanced range high is say, okay, now the market is breaking out and now it's moving from a period of was once balance to now a period of imbalance. The imbalance is the market moving up because aggressive buyers winning the battle outweighing those passive sellers. So now you have buyers winning against those sellers because the market is discovering new prices and auctioning higher, and now holding runners until the market bases out, especially if you're a longer term or middle term trader, is the concept here because the market goes from balance to imbalance to balance to imbalance. And that is the basis to the strategy. It's very powerful. You first have to understand the concepts of a market's auction. And then once you implement it into your own strategy and combine different pieces of confluence, it's very powerful. But I'm going to end the video on that note. If you learned something from it, I would appreciate a thumbs up and also for you to subscribe to my channel. Peace out.